When markets crash, everything is correlated. Everything except this one asset, which you might not like. We're going to talk about that here today. We're going to look at a little bit of my man Nassim Nicholas Taleb. He had a piece I can read about in a different video here. I'll give you two paragraphs from it right now. And then we're going to show you the real life history of the nature of correlated assets in a market crash and why this whole thing of modern portfolio theory is bunk. I would assume most people know this, but I cannot make that assumption because we make those assumptions. If you assume anything, it makes an ass out of you and me, as you probably heard that. Sadly, many people who are professionals, quote unquote, in my industry, they follow this whole. It's frustrating. They just follow the herd, man. They said, well, everyone else is saying it, so I better say it too. All right, so let's read this. And I'm going to read this article from Nassim Taleb here in a little bit. Or Nassim Nicholas Taleb. Yeah, Nassim. But it's called Safe Haven. Safe Heaven. And forward to Mark Spitznagel's book, Safe Haven. Buddy, he's eating my wife's flowers. Not cool on Birthing Mother Day. All right, so we're going to go down here. All right, right here. All right, never underestimate people's needs to look good in the eyes of others. Scientists and artists, in order to cope with the absence of gratification, had to create such a thing as prizes and prestige journals. These are designed to satisfy the needs of the non-heroics to look good on occasion. It does not matter if your idea is eventually proved right. There are intermediary steps in between that can be won. So, quote, research, unquote, will eventually be gamed into some branch of non-research that looks cosmetically like research. You publish in a, quote, prestige, unquote, journal, and you are done, even if the full idea never materializes in the future. The game creates citation rings in clubs and fields like academic finance and economics with no tangible feedback, where one can BS endlessly and collect accolades by peers. For instance, the theory of portfolio construction, or the associated risk parity, a la Markowitz, requires correlations between assets to be known and non-random. Are you hearing that? The theory of portfolio construction, modern portfolio theory, requires correlations between assets to be known and non-random. You remove these assumptions and you have no case for portfolio construction, not counting other vastly more severe flaws such as ergodicity discussed in this book. Hold on a second. All right, let me read this again because it's so critically important. The theory of portfolio construction makes you have to assume that your assets are both known and random, the correlations between them. All right. Yet one must have no knowledge of the existence of computer screens and no access to data to avoid noticing that correlations are, if anything, not fixed, but they're changing randomly. People's only excuse for using these models is that other people are using the models. And thus, you end up with individuals who know practically nothing, but with huge resumes and even have a Nobel Prize. These citation rings or circular support groups were called mutia mule by the ancients, the Association of Mutually Respected Mules. All right, so remember, he is saying you must have no access to data to avoid noticing that correlations are, if anything, not fixed and changing randomly. What does that have to do with anything? All right, so we know I have these non-correlated assets. I have international, I have small cap, I have gold, I have commodities, I have real estate, I have blah, 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 blah. All right. And as such, my portfolio is constructed in such a way for risk mitigation. It's freaking insanity on steroids. There's no risk mitigation in, quote, non-correlated assets, unquote, because in market crashes, everything is correlated. Let me show you what I mean by that. All right, so we're going to go down here we're going to look at old Yahoo Finance, look at a USA Gold and Precious Metals Fund, all right, USAGX, literally the top performing fund in 2000 in the aughts, top performing. All right, and we're going to go year over year history, and we're going to start in 2001. It was up 31%. In 2002, it was up 67%. Interesting. So everything else was getting crushed in 2002 in particular. Maybe not 2000 and 2001, but certainly 2002. Everything was getting crushed except for gold and precious metals. It was up 67%. All right, so you with me so far? Now, we fast forward until 2008. It was down 24%. Interesting. All right, so we're going to look at, I don't think we had VTV. Let's just go to VFIINX. This is the S&P 500. Just give an example. S&P 500. We're going to go to performance. I'm using the Vanguard S&P 500 to show you, and we can go to small caps. We can go, and you name it. All right. S&P 500, you can see it was down 2001 and 2, and it was down in 2008. All right, so again, gold and precious metals smoked it in 2001 and 2002, but got smoked in 2008, as did the S&P 500. We'll go to small cap index, ASX. This is the Vanguard Small Cap Index Fund. Let's take a gander, shall we? Small cap index fund. Let's go to performance. And what we'll see is small cap index. Well, not really all that correlated with the S&P 500. A little bit here. We got negative 20% in 2002, but 2001 is basically middling. But then in 2008 got smoked. All right. Let's go to the Vanguard Value Index Fund. Let's see. Investor shares VVAX, because this is more dividend-oriented. Growth, dividend-oriented value stocks, and that should have done better in 2000, 2001, and 2, which I guarantee it did. And we can see in 2001, 2000 it was up, even though S&P 500 was down. 2001 was down, 2002 was down, and then 2008 got smoked. All right, let's go to Vanguard REIT and see what that did. Real estate. Oh, it was just... Oh, right there. Vanguard Real Estate Fund was right. Hold on a second. There's a Vanguard Real Estate Index. Whoa, it was way up in 2001 and 2. Woohoo! So everything else was getting crushed. The Vanguard Real Estate Index was up, and then it got crushed in 2008. Okay. Let's see. Let's go to commodity. The USA Gold and Precious Metal Fund would be a commodity play. So let's go to European. So Vanguard European Stock Index Fund. And we go back to 2000. It was down 2001 and 2. Down got smoked, and it got smoked in 2008. So definitely some correlation there. Let's go to, we'll try Japan. Here's the Pacific Stock Index Fund. Down in 2001 and 2. And again, 2008. Okay, let's go to bonds. Let's go to Vanguard Long-Term Bond Fund. Let's see what we got here. Oops, hold on a second. Vanguard Intermediate Term Investment Grade Fund. Let's see what that did. Oh, wow, look at that. 2001 and 2 was up 10, 9, and 10, and then 2008 was down 6%. Wonder why that is. Let's keep looking. Vanguard High Yield Corporate Fund. Let's keep going down. 2001, 2 is down less than 100 basis points. 2001 was up. 2002 was up. Not much. 2008 got smoked. Interesting. Let's keep looking. Tax-exempt funds with GO, government obligations, would do okay, right? Well, here's the Vanguard Tax-exempt California. 2008 was down, even though 2001 and 2 it did pretty well. 10.94 in 2000, 4.43 in 2001, and 9.16 in 2002. But it did lose money in 2008. So let's keep looking. Yeah, the Vanguard Long-Term Tax Exempt Fund, because interest rates have been going down, they should have done fine in the odds, right? Oh, in 2001 and 2 it did great, 13, 4, and 10, and in 2008 it was down 4.87. So we can play this game until we're blue in the face. The one asset class that actually survived in 2008 was anything to do with government bonds. Let me show you what I'm talking about. Vanguard Long-Term Treasury, all right, Long-Term Treasury Bond Fund. It was up in 19%. 2001 and 2002 was up 4 and then 16.7. 2008 was up 22.51. But Josh, the reason it was up is because they were lowering rates, so of course it'd go up. Okay, then how come corporate bonds didn't go up? But let's take a look, shall we? Vanguard Intermediate Term Investment Grade Fund, all right, intermediate investment grade, no junk bonds, 2001 and 2 is up 10, 9, 10. Again, in 2008 it was down 6.16. All right. So again, you can see where I'm going with this. So basically, the only thing that did well in 2008 was government bonds and cash. That's it. And if we go to Ginnie Mae, my favorite, Ginnie Mae, VFIIX, we can see Ginnie Mae was down, was up 11% 2000, 8% 2001, 10% in 2002, and then in 2008, it was up 7.22. So, everything is correlated in a market crash except for government bonds and cash. That's it. That's it. You can't escape it. Now, fixed annuities, all right, I'll grant you that, but I'm talking about investments, and that's not an investment. Insurance product is not an investment. It's an insurance product. Everything is correlated in a market decline except for government bonds and cash. Now, will that continue to be? Probably, frankly, because the facts are the government can pay off. They're guaranteed to pay off their debt. That's 100%. There's no private entity, an insurance company, a bank that can be more secure than the federal government to guarantee to pay off its debt. And the one thing that matters when the market is declining, everyone wants this flight to safety. So stop with all this. I got to have uncorrelated assets because there is no such thing, man. There is no such thing. The only non-correlated asset, and of course, people say, here's the problem with correlated assets, uncorrelated assets. You're saying, I don't know what's going to go up. I don't know what's going to go down. So I'm going to be diversified, non-correlated, so I can have at least a little bit of exposure here, a little bit of exposure there, a little bit of exposure there. So if this thing goes way up and this thing just stays flat, I'll have exposure to that. I have no qualm with that. None whatsoever. None. I don't have any qualm with that. But you're non-correlated those assets not to protect you downside risk mitigation. You're correlating those assets to make sure you gain some of the upside. You're saying, I need to capture some of the upside of X, Y, Z. I get that. But if you're trying to have non-correlated assets to give you risk mitigation, that's foolish, man. You cannot do it. The only way to do it is to have government bonds and cash. That's it. And that's why I love the barbell. Because the barbell says I'm going to have government bonds and or cash to provide me my risk mitigation. Now, I get a lot of questions like, what about the Wellesley for my cash? Well, let's take a look at what Wellesley did. We go to Wellesley, VW Inks, and it was down 10% in 2000. It was down 10% in 2008. Now, that may or may not be doable. I might do it. But here's 2008. It was down 9.84. But remember, from actually, we can go to let's go to hold on a sec. Wellesley, we can go from the top to the bottom of. We're going to go back to October 2007, where it's trading at let's see, 14.19 adjusted for dividends and all that, and then we go down to the end of March of 2009. It's trading at 11. So if I take my trusty calculator, we say 14.19. Hold on a second. Let's see here. Need my calculator. 14.19, 14.19 minus 11.37. Actually, well, if we even go to daily, let's just go to daily. Let's see if we can go to weekly here. So I'd like to 1088. Let's go to daily. We're going to apply that. 14.19 to 1088. Look at that, man. To 10. I want March 9th. That's when the market. We'll do March 10th. There we go. Apply. Yeah, okay. That's March 18th. So we fell to 1081 March 9th. There we go. Why did I give me 1081? 10.81. Divide by 14.19. That is a 23.8% decline. That's adjusted for dividends, by the way. So over the course of 18 months, the Wellesley was down 24%. What was cash down? Nothing. What was Ginnie Mae down? Nothing. You got to remember that. Don't just follow the herd. And they say, oh, you need non-correlated assets, Markowitz, modern portfolio theory. I'd love to hear your thoughts. All right, we'll see you.